Well, the year may be off to a great start for Junior, but not so much for investors. After a mediocre 2015, the markets are off to one of the worst starts in years in 2016. In this week's U.S. Bank Economic 360, U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman joins Business Courier editor Rob Dahlmeyer to talk about what it all means. Rob and Mike.
Thank you, Peg. And as Peg just said, last year was not great. What's going on now?
This year, so far, not so great either. Yeah, as Peg mentioned, by some measures, it's the worst start to a year ever for the stock market. So, you know, in some regards, maybe not terribly surprising. You know, we've been dealing with a nervous market and some wide swings both up and down for the last few quarters. So we're getting used to that aspect of it, but the timing might be a little bit surprising. This is typically a very strong time of the year for the market. Usually a Santa Claus rally in December. Right. Stocks finish on an upswing. We didn't get that this time around. In fact, last month was a losing month for the market. January is usually so strong that it has its own title, you know, the January effect. We're only a few days in, but to this point, January effect nowhere to be found. So, you know, we don't want to extrapolate too much. It's impossible to draw a lot of conclusions from such a small sample size. But it is a little bit concerning that what's typically a very strong time of year for the market is anything but.
So what's behind this? What are people saying?
Well, you know, again, in some ways, it's a little bit just more of the same. Yeah. This volatility that we've been seeing, the market on edge. But then it's been sort of compounded, if you will, this past week by this steady stream of bad news coming from overseas. Some of that is economic in nature. China has some real concerns about the health of their economy. That's led to a sharp decline in their stock prices, which in turn led to a sell-off in Europe, which in turn leads to a sell-off here. So China certainly has added to the confusion. But there's also geopolitical concerns as well. You know, tensions in the Middle East, what's going on with North Korea. You know, these types of events don't do the market any favor either. So you take a market that's already on edge, you pile some of these additional things on, and what you get is a pretty lousy week for stocks.
So we're in the first 10 days or so of January, and you just said a minute ago you don't really want to extrapolate, but let's go ahead and try anyway. What should we expect this year, maybe even just in macro terms?
Sure. So again, yeah, you can't take a small sample size and use that to determine how the year as a whole is going to go. We could easily see some quick reversals, or of course it could get worse. We just don't know at this point. Some things we do know, however, if we're looking for silver linings, is that right now is really not that bad an environment for stocks. In general, stocks aren't overvalued. The economy is doing okay. Corporate earnings are doing okay. Interest rates low. Inflation's low. Price of gas is low. All of these set up for a really nice scenario for stocks. But still, we're seeing a lot of market observers who are saying, you know, hey, we're not that enthusiastic about 2016. You know, as Peg said, last year, very mediocre. This year, frankly, might not be much better. So, you know, we'll see that play out over time. Things seem to be set up nicely, but that doesn't always equate to a strong market. But again, the one thing we shouldn't do is say, well, boy, we had that first week, that was lousy, and you know, everything's going down from there.
Well, we'll keep our eyes on China. We'll keep our eyes, obviously, on the interest rates, and I'm sure you and I will be talking about this again.
Absolutely.
Thank you very much.